Hello friends, today we are going to discuss another very important topic, which is single entry system. No doubt at CA Inter Group 1, and this topic is, we can say, like it is a grade topic. Almost in Group 1 there are around 4 to 5 topics which are very important, and those topics should be taken care while solving the problems, and we should understand complete 100% concept to solve the sums. But of course all the topics may not be like that, and I said that around in Group 1, entire Group 1, and hardly like 4 or 5 topics like that. And we can say single entry and particularly branch accounts. These two are undoubtedly very important, and some other important topics also there, we can discuss them later. So anyhow, in the Group 1 there are around 4 to 5 topics which are very important, and a student should understand completely 100% conceptual base. Okay, I can say definitely say this is that kind of topic. Single entry system is that kind of topic. So today just I will introduce about a single entry definition, completely theory part related to single entry system we can discuss today. Problems and we can discuss in the next class. Today we can discuss only theory part related to single entry system. First, let us come to know what does it mean a single entry system, and generally who will follow this particular single entry system. So first let us come to know what is the definition of single entry system. We all know very well what is the definition of double entry system. So double entry system means in every transaction two aspects are there, receiving and also giving. And if receiving, giving, both aspects are recorded into the books, that system is known as a double entry system of bookkeeping, which is a perfect system of accounting, transparent system of accounting, and definitely it is a scientific system of accounting also. Definitely if you incorporate the double entry system of accounting, and you can produce very perfectly your results of your business. So by the preparation of like a journal, ledger and trial balance, and of course final accounts. And definitely everybody would like to incorporate double entry system only, undoubtedly, because that system is such a great system of accounting. But only the problem here is to incorporate that system, and a huge cost to be incurred there. So because you have to maintain the journal and ledger, and you have to maintain the books throughout the period, and you need to appoint an accountant, and one should have complete knowledge, the double entry knowledge, to maintain the books and all that. So that definitely if you can afford, and you may go for double entry system of accounting. For example, and you are unable to afford that much of money, and moreover if you incorporate double entry system of accounting, and definitely it will be more useful for decision making. Very few chances are there to occur any kind of fraud. No fraud may occur. So easy to detect the errors. And so many advantages are there by incorporation of double entry system of accounting. So that most of the people, they prefer to follow the double entry system because of so many advantages are there. Then why single entry system is certainly preferred by certain people? The reason. What is the reason? And let us come to know the single entry system definition and all that also. Particularly if you can afford, and if you would like to incorporate the great system of accounting, and if you can afford, you may go for double entry. So no sir, I cannot afford that much, and just I want to know the result of my business, that's all. And in such a case you may go for single entry system of accounting. So need not to spend that much of amount which you have to spend in double entry system of accounting, and single entry system you need not to spend that much of amount to maintain the books. Very easy and simple to find out the result in single entry system. So that generally small concerns, they prefer to follow single entry, and large scale concerns, and who can afford amount, and who would like to know the results in a very perfect way, and who would like to maintain the books in a transparent manner, and definitely they prefer to go for double entry system of accounting. But normally we may find sole trade and partnership, and of course company. Sole trade and partnership firms, they have the option to go for either single entry or double entry. But in case of company, it is a mandatory, they should maintain the books only on double entry, under double entry pattern. And also Companies Act prescribed certain set of books, and you need to follow the same. and moreover double entry system. But in single entry system, and you may follow in case of sole trade and partnership, and you may follow single entry or double entry, that is your choice. But double entry, which we all know very well, very clearly, very important thing is to work out the sums in single entry. So one should have the complete knowledge about double entry first of all. So we know very well about double entry, and since long time, and we have been learning about the double entry system. Simply the process started with journal, followed by ledger, and followed by trial balance and final accounts, and all that is a part and parcel of double entry system. So already I defined very clearly, double entry system means in every transaction two aspects are there, receiving and also giving. If both receiving giving aspects are recorded, that system is known as a double entry system, which is a perfect, scientific, transparent system of accounting. Now let us come to the single entry system of accounting. Sole trade partnership firms, they may follow single entry system also. How you can define single entry system? First of all, single entry system, it is said like incomplete record. Okay. Normally what the people they used to say, if two aspects are recorded, which is called double entry system. If only one aspect is recorded, that is a single entry system. Normally people they think that. It is not like that. It is not like that. Single entry simply defined as which is not a double entry, that is a single entry. Which is not a double entry system, that is a single entry system. Single entry will not have any specific particular definition. Why? Because incomplete will not have the definition, a complete only will have the definition. Say example, I have given you 100 pages work and you completed all the 100 pages work. What you say? Work is finished. Which means if 100 pages work is completed, it is known work is completed. How can you define the incomplete? 99 pages are finished and I can call it is incomplete. 50 pages are completed by you, I can say it is incomplete. 5 pages only written by you, which is called incomplete. So incomplete will not have any particular definition. Only the thing, if 100 pages are not written, it is complete. Okay. So definitely incomplete means which is not complete. I can say if 100 pages are written, that is complete. If 100 pages are not written, that is incomplete. That's all. So incomplete will not have any particular definition. Like that, single entry will not have any definition, which is not a double entry, and that is a single entry system of accounting. That's what I can say. If someone is going to ask the definition of single entry and you need to say the same and you can't define it properly. So which is not a double, I can define double entry perfectly. So in every transaction, two aspects are there, receiving and giving, and both aspects are recorded. That system is known as a double entry. But in that way, I can't define single entry. If one aspect is recorded, which is known as a single entry, I can't say in that way. I will tell you why it is like that. If two aspects are recorded, that is double entry. It does not mean that if one aspect is recorded, that is a single entry. Simply I can say which is not a double entry, that is a single entry, which is incomplete record, that's all. So for example, you want to define the single entry in a better way. In a better way, you want to define a single entry. How can you define? Single entry I can define, it is a mixer of single entry, double entry, no entry. Single entry first, in the first instance I can define single entry means which is not a double entry, that is a single entry. Secondly, I can explain in a better way this particular single entry system. Definitely, say example, I defined like that, which is not a double entry, that is a single entry, and you are not satisfied if that is not, and this is what you are saying, sir, and you make it more clear. Then I can explain it is single entry means it is a mixture of single entry, double entry, no entry, which means sometimes I can record both the aspects, receiving, giving aspects into the books. Sometimes I can ignore both aspects, receiving, giving. Sometimes I can accept, I can consider one and I can ignore the another one. So I can define that it is a mixture of single entry, double entry, no entry. I can simply say that in single entry system, normally we used to maintain throughout the year cash book to record all the receipts and also payments. Secondly, they maintain the personal accounts to know how much amount due to others and how much amount due from others. Irrespective of the scale of the business and one should maintain this cash book as well as personal accounts. These two are very important, and what is coming and what is going to know cash book, and also from whom the amount is due and to whom I have to pay to know personal accounts. Personal accounts and cash book both are maintained in normally in single entry pattern. Right now I explained that it is a mixture of single entry, double entry as well as no entry also. Sometimes I can record both, sometimes I can ignore both, sometimes I can write one aspect, I can ignore another aspect. So I can simply give the example here for all of these three. Okay. For example, cash paid to Rama, let us say rupees 5,000. So what would be the entry here? Rama account debtor to cash account, that is the entry. Okay, and obviously I said that cash book is maintained, so this is there. Personal accounts also maintained, this is also there. I recorded both the aspects here. Let us say second one, depreciation on machinery. Depreciation on machinery, let us say rupees 10,000. So what is the entry for that? Depreciation account debtor to machinery account, 10,000. Depreciation is a non-cash expense and nominal. Here no account is maintained. Machinery is a real account and asset. No account is maintained. So here both aspects are not recorded. Here both aspects are recorded. Third one is machinery purchased on cash. Let us say rupees 1 lakh. Entry machinery account debtor to cash account, rupees 1 lakh. And what we can say here, machinery account is not there, but cash account is here. So I can say when you maintain a cash book and even personal accounts, and I can simply say like this. Okay, I said that in single entry they used to maintain a cash book to know what are the receipts and payments, and they maintain the personal accounts also only. So no nominal accounts, no real accounts are maintained. Only cash book and personal account they usually maintain. Okay, therefore I can say initially how I explained about single entry system. Single entry is incomplete record. Otherwise I can say, don't think that if one aspect is recorded that is a single entry. Okay, single entry is simply defined which is not a double entry, that is a single entry. Or if you want to make it more clear, single entry, we can say that which is a mixture of single entry, double entry and no entry. I can write sometimes both aspects, I can ignore both aspects, sometimes I can consider one aspect and I can ignore another aspect. You can take all the examples. Cash paid to Rama, Rama to cash, both are recorded. Depreciation on machinery, depreciation to machinery, both are ignored. Machinery bought on cash, machinery to cash, one is ignored, another is recorded. So that I can say it is a mixture of single entry, double entry and no entry. That is what we can simply define. So now definition is very clear. Single entry means which is not a double entry system. First you have to say, when you want to define in a better way, you can say it is a mixture of single entry, double entry, no entry, and these examples you may give it. Okay sir. I said already, companies they need to follow in a mandatory manner only double entry pattern. Sole trade partnership they can have the option to maintain the single entry, even double entry also. Definitely double entry can give the very clear picture about business. Only the thing it is costly, you have to maintain and books throughout the period, journal, ledger, etc, etc. But in single entry you need not to maintain like that. Simply you may write a cash book and you maintain the personal accounts. To write the cash receipt and payment and to maintain the personal accounts, and need not to have such a great knowledge. Anybody can write it. So except these two, normally you may find that even single entry under single entry system, and those are also again classified in three categories, single entry. But of course, no doubt this is a popular one, and this is what we are discussing right now. As I said, cash book, personal accounts. But actually they are defined in three ways. One is a pure single entry system. In pure single entry system, they used to maintain only personal account. Say example, very small business houses are there and they do not maintain cash book also, but they can maintain the personal accounts. Personal accounts in the sense they used to work out in their own manner. They can say how much amount is due to others and how much amount is due from others. They are able to say. So they maintain the personal accounts. They do not maintain even cash book also, which is pure single entry system. This is what very important, simple single entry system. In this particular method, what I discussed right now, they maintain the personal accounts, no doubt. They maintain cash book also. So this is a popular one, and what we consider most of the cases, the second one, simple single entry system. Lastly, quasi single entry system. In this one, they maintain the personal accounts and they maintain the cash book, and of course they maintain some additional subsidiary books or registers also. Like example, purchase register they require. So they maintain the purchase register. For example, they want to have the more details about the sales, they may maintain the sales register. So that along with personal accounts, along with cash book, they can maintain some registers also. But anyhow, not complete set of books. Okay. So this is the way you may discuss pure single entry system, simple single entry system, quasi single entry system. But right now we consider in most of the cases like simple single entry system. Means they used to maintain throughout the period only personal accounts, and they maintain a cash book. No real accounts and no nominal accounts. And immediately there will be a big question mark in our mind. What is a big question mark? When the nominal accounts here not maintained, how we are able to know the profit loss? Because profit loss can be known only by the nominal accounts. Excuse me. So nominal accounts, only by the nominal accounts, profit loss can be known. We know that expenses, losses and incomes and gains. Difference between the income gain and expenditure loss is a profit or loss. But here no nominal accounts are there. How do you know profit loss of the business? No nominal accounts and no real accounts. Only cash book, personal accounts. How to know the profit loss here? That is a very, very important question if you follow in single entry system, and how profit can be known. Because no nominal accounts are appeared. In this particular single entry system, profit can be known in two ways. Okay. One is throughout their books maintained in the single entry pattern. They would like to know the result only by single entry pattern. Second one, throughout their maintained books in single entry pattern, at the end of there they want to convert single entry into double entry. I repeat once again. Throughout the year they maintain the books under single entry pattern. At the end of the year also they want to know the result only by single entry pattern. Second method, conversion method, which we call, throughout there they maintain the books under single entry. At the end of there they want to convert single entry into double entry. We can discuss the second method later. First, let us come to know the first method. Throughout there we are in single entry pattern, means we maintain personal accounts and cash book only. At the end of there I want to know the results in single entry pattern only. How I am able to know in single entry pattern? In single entry pattern, profit can be known simply in the way of capital comparison method. It is also called net worth method. It is also called statement of affairs method. I repeat once again, in single entry pattern, throughout the year you are single entry, means you maintain only cash book and personal accounts, nothing else. Except cash book, except personal accounts, no nominals, no real, nothing. How profit can be known at the end of there? By single entry system only. By capital comparison method, which is called net worth method, which is also called statement of affairs method. Capital comparison method, how in the capital comparison method profit can be known? Is simply compare the opening capital and closing capital. The difference simply I can say profit. Say example, opening capital is 10 lakhs, year beginning capital, year ending capital is 20 lakhs. I can say 10 lakhs is a profit, definitely. Is it? Yes. Unless drawings is there during the period, unless some additional capital brought in is not there. Because except additional capital brought in, except drawings, except nominal accounts, except these three, no any other account can touch the capital account. No any other account will touch the capital account. Only these particular accounts items, they will affect the capital. Say example, if you bring some additional capital, capital will be increased. If drawings are made, capital is decreased. Sir, no additional capital brought in, No drawings made during the year. Opening capital is 10 lakhs, closing is 20 lakhs. Will you say 10 lakhs is a profit? 100% sure that is a profit. If capital is increased, I can say profit. If capital is decreased, I can say loss. If there is no drawing during the year, if there is no additional capital brought in, because these three only will touch the capital account. If you bring some additional capital, increase in capital. If drawings are made, decrease in capital. Otherwise, nominal accounts. So, if someone says that no additional capital brought in, no drawings are made during the period, capital is increased when you compare to the beginning and closing, will you say that is a profit? 100% profit. If capital is decreased from the beginning year to the end of year, will you say loss? 100% loss. So, this is what capital comparison method. Okay, sir, you are saying that capital, opening capital and closing capital by comparing, and you would like to say profit loss. How capital can be known? First of all, opening capital and closing capital. Because no assets are there. How do you know? Therefore, there are no any assets account and ledger accounts are not there. By the source of information we can gather in the beginning of year, different sources will be there. By the different sources I can bring the data. So, and therefore I am not going to call like it is a balance sheet. I can call it is a statement of affairs. If I bring all the ledger balances and I prepare, which is called balance sheet, but here not through ledger balances, I can bring the data by the different sources. I can prepare a statement of affairs in the beginning of year. Asset minus liability is equal to net worth or capital. In the similar way, at the end of the year also, I can bring all the assets and minus liabilities, net worth or capital. I can compare both of these two. I can simply say the profit loss. How opening statement of affair, closing statement of affair can be prepared, and how we are able to know the information related to assets and liabilities. Okay, I will explain these 3 points, 1, 2, 3 points explain, and come to the preparation of a statement of affairs. While preparing statement of affairs, what are the different sources, and so to bring the various amounts into while preparation of balance sheet. First one, how to get the cash balance and bank balance. Already you are maintaining cash book. You may maintain cash and bank columns also. So check your cash balance and also check what is cash in your hand. By considering that, you can take cash balance. You are having bank columns. You can bring the bank passbook, compare both of them and take the bank balance also. Okay, you may take cash and bank balance in such a way. Debtors as well as creditors, you are maintaining all the personal accounts. Having debit balance, all put together, they are called debtors, trade receivable. You are having personal accounts, and some personal accounts are having credit balance. They are called as creditors. Put together, they are called creditors, trade payable. That is also simply can be known. Stock in trade. How stock in trade can be known? At the end of the period, when you would like to know the closing stock, please stop the business operations for a day, purchase and sales, and take the counting of all the goods units left with you, which is taken at the closing stock. And of course, you know that should be always at cost or market price or NRV, whichever is lower, and you may follow that principle. Next, fixed assets. So like machinery, computer, furniture, etc., etc. Definitely these fixed assets, whenever you purchase, and the related papers, vouchers or any other documents may be there. So based on that, you can take the asset and concerned respective depreciation also you may charge that. And meanwhile, you need to consider any expenses you have to pay, outstanding expenses or any advance paid expenses. Otherwise, receivable income earned but to be received, accrued income, advance received income, and those items also to be considered here. Means it is to be done always here, accrual system we are following here. Excess of assets. So when you consider all these in these different ways, you may find out all the assets and liabilities, not by the ledgers, by the sources. You can have a statement of affairs, put all the assets right side, put all the liabilities in the left side. Asset minus liability represents capital. How, in which way you have done opening statement of affairs, in the similar way you can prepare closing statement of affairs also. Find out the opening capital and closing capital. When you have the opening and closing capitals with you, and you can have simply a statement of profit. This is the way simply to statement of profit. Already I said that there are two methods to find out the result, by net worth method, conversion method. We can discuss this conversion method later, but we can discuss the net worth method. In the net worth method, capital comparison method, which is also called and which is also called statement of affairs method. I can prepare opening statement of affairs, I can find out the capital in the beginning. I also can find out prepare a statement of affairs at the end. I can find out a closing capital. When I know the closing capital and opening capital, I can prepare simply this statement of profit. First, I used to take the capital at the end of their closing capital. I can compare opening closing capital. Difference, I would like to say profit. If any drawings are there during this year, I would like to add back. Why? Because if any drawings are there, and obviously they will reduce your capital, but they will not reduce your profit. That is a part of profit. Capital is already reduced because drawings are made, but your capital is reduced, but profit is not reduced, so it should be added back. If any drawings are made, that should be added back to your closing capital. If you bring some additional capital introduced during this year, and obviously it will be in your closing capital, but you can't say it is your profit, so that is to be deducted. If any drawings are there during this year, it should be added back, because that is nothing but your profit. That's why I did. If any additional capital during the period brought in, that should be deducted, because it is not the profit. It is there in closing capital, but it is not your profit. And out of this adjusted capital, if any opening capital, if there is a opening capital, and that should be deducted. Simply this is known as a trading profit loss. Closing capital, add drawings made during this year, less additional capital introduced, less opening capital, which is simply known as a trading profit loss. It is not the profit loss completely, it is a trading profit loss. By the trading, this profit loss generated. Okay, by the trading, this profit loss generated, but still some notional items to be adjusted. Still some notional items to be adjusted, like interest on capital, partner's capital. So that the amount should be given by the business to the businessman. Interest on drawings, it should be given by the businessman to business. Salary to or commission to partners, this should be given by the business to businessman. These are all now notional items, what we call. Those items, they reduce profit and they may increase the profit. Those items to be adjusted separately, because this is a profit can be known only by the trading only. If any this kind of notional items are there, they should be adjusted. Okay, and in this way, and we can handle this. Okay, so there are some important and notable points are there to discuss. Okay, what are the important points and how to discuss while solving a problem in single entry system, and we can see what are the important points to be considered while preparing statement of affairs, opening and also closing. So when you would like to know the profit loss in single entry system, okay, while preparing statement of affairs, beginning and closing, certain important points should be considered. What are the important points to be considered? The first point is a fixed assets. Particularly like fixed assets like machinery, motor car, building, etc. These assets are given. So in the beginning, and while taking these fixed assets in the closing, if there is any purchases during this year should be added. If there is any sale should be deducted. If there is any depreciation is given, that should be deducted. Purchase add, sale minus, depreciation minus. The remaining amount should be taken after adjusting these items, and adjusted asset should be taken in the closing balance sheet like asset. Say example, nothing is mentioned, no purchase, no sale, no depreciation. You can assume the same fixed asset is at the closing also, you can same as it is. Say example, machinery at 1 lakh. No information regarding machinery during this year, regarding depreciation, purchase, sale. Take as it is 1 lakh at the closing also. So while taking fixed assets from the opening to closing, purchase should be added, sale should be deducted, depreciation should be deducted. Nothing is mentioned, you can take as it is. By the assumption, same amount is carried at the closing also. Next, like current assets, current liabilities, stock, debtor, bills receivable, bills payable. So these current asset, current liabilities, you never assume that which are there in the beginning, they are at the closing also. Definitely their amounts will be changed, sometimes nature also may be changed. Say example, bank balance at the beginning favorable, at the end it may be changed like a OD also, not amount. Even balance also may be changed. So you can't assume that and opening and they are as it is at the closing. So certainly this opening current asset, current liabilities will be certainly changed during this year because of doing of business, stock, debtor, creditor, cash, bank, etc. So that they should be given at the end of the year, and whatever the balance is given, current asset, current liabilities at the end of the period, and of course we need to take them. Okay, but you can't assume that which is there in the beginning at the end also. So their amounts and even their nature of balance also may be changed. Third one, drawings. If any drawings are given, should be very clear about the capital drawings and ordinary drawings. Say example, 10 lakhs capital is there, 20,000 drawings is there. So you may have a doubt whether drawings to be deduct 10 lakhs minus drawings 20,000, 9 lakh 80,000, whether I have to calculate interest on capital on 10 lakhs or 9 lakh 80,000. You have to calculate only on 10 lakhs. Normal drawings should not be deducted from capital while calculating interest on capital. So you calculate interest separately. If any interest on drawings given, it should be calculated separately, but need not to minus the drawings from capital while calculating interest on capital. Say example, capital withdrawn, then you have to minus. Say example, 10 lakhs capital is there. Okay, so at the end of the 6 months, 5 lakhs withdrawn. Only 5 lakhs is there. For first 6 months, 10 lakhs interest to be calculated on 10 lakhs. From the July 1st onwards, when 5 lakhs is withdrawn, on the remaining 5 lakhs only interest to be calculated for the remaining 6 months. So while calculating interest on capital, capital drawing should be deducted, normal drawings should not be deducted. That is regarding drawings. Next, fixed assets and investments. Fixed assets and investments always to be recorded at the historical cost, and particularly fixed assets to be depreciated by the wear and tear, but to be recorded at the cost price, but need not to consider the market price irrespective of market value. Your fixed asset may have any market value and investments also may have any market value, need not to consider. But in case of investments like shares may have nominal value, face value, but nominal value, face value, market value, and all this is not to be considered. Write fixed assets always investment at the historical cost, at what price you purchased. Fixed assets may be depreciated by the wear and tear. Next one, stock. I said already, inventory to be calculated at the end of the year by physical count checking. You may calculate cost or NRV, whichever is lower. And meanwhile, while doing here, you have to work out here not on cash basis, accrual system. In accrual system, expenditure to be considered whenever it is incurred, income to be considered whenever it is earned, cash system whenever it is paid and received. But here you need to follow accrual system, expenditure incurred, income earned. Therefore, we have considered outstanding expense, prepaid expense, accrued income, advance received income. All they will be considered only under accrual system of accounting. That's what we need to follow here. So even if you taken any loan from the family members like wife and from relatives, and that also should be considered like a liability to business. And of course, even you contribute as a partner some loan given by you to the business, that is also liability. Therefore, if any loan taken from the family members, it is not a capital, it is a liability. Goods sent on sale or return basis. We know that it is a kind of marketing technique. When you send goods sent on sale or return basis, so there are so many methods to write. We know that there is an ordinary sale method. In that method, we used to write normal sales entry, customer to sales, debtor to sales. But while closing books, and we came to know, and those goods are not accepted, not rejected, time is also not yet completed. Then we have to cancel the sales at sale price, generate the stock with cost price. Sales cancellation entry, sales to debtors. Sales to debtors, that is to be written with sale price. Second entry, stock with customer to trading account. Stock with customer to, because sale is being cancelled. Of course, for that stock we are the owners. That stock to be generated. Stock with customer to trading account. This is to be written with cost price. So, in here no sales is there, no trading account is there, only because we are working profit loss through statement of affairs. Therefore, debtor to be reduced, sales to debtor means debtor to be reduced at sale price. Stock with customer to trading, no trading is there. Stock generated at cost price. Debtor to be reduced by sale price, stock generated at cost price. Whenever it is given like sale on approval, sent on approval basis. And last point here is, so particularly there is a big question mark in mind whether you have to take in balance sheet cash book balance in the balance sheet, bank balance, or passbook balance which you have to take. not cash book balance, not passbook balance. We have to take amended cash book balance, you have to take into the balance sheet. What is amended cash book balance? Amended cash book or adjusted cash book balance means we know that cash book and passbook both they differ due to 4 reasons. What are the 4 reasons? Some transactions recorded by us, not recorded by the banker. Some other transactions recorded by the banker in passbook but not recorded in our cash book. And another one, mistakes committed by us and mistakes committed by the banker. These are the 4 reasons. Out of these 4 reasons, if you check that, in case of 2 reasons, there is no any problem in our cash book because some transactions are recorded in our book. Say example, deposited but not collected, issued but not presented. Record in our book already, not recorded in the passbook. Why should we bother about it? And he can record. But they are recorded but we are not recorded in our cash book. Let us amend them. Let us record in our cash book. Customer directly deposited into bank. Passbook credit. Let us debit to cash book. Bank charges. Passbook debit. Cash book credit. In that way you can record. So that is clear. Another one, you committed some mistakes in your cash book. You please correct because cash book is with you. You can amend it. Some mistakes are done by the banker in passbook. Why you have to bother about it? Mistakes done by the banker and he will take care of. So if anything is written by you and not written by the banker, you do not have any problem. If something is written by the banker and not written by you, you can write here in the amended cash book. Some mistakes are committed by you, please correct. Some mistakes are done by the banker, you need not to worry. So that once you cash book you are converted as an amended cash book or adjusted cash book balance, it is completely correct bank balance, I can say. That balance you have to take into balance sheet like a bank balance. Not cash book, not passbook. Amended cash book balance you have to take into the balance sheet. Sometimes you may be given, while taking amended cash book balance, it is given you are given a passbook balance. You have to convert that passbook balance into cash book balance and you have to take. In such a case, what you are supposed to do, passbook balance is given, you have to convert into cash book and you have to take cash book balance. Then checks deposited but not collected, means you have recorded but bank is not recorded. In the passbook you can add that, then it will be equal to cash book. Issued but not presented, cash book is reduced but passbook not reduced, you can reduce. So deposited but not collected added, issued but not presented deducted. And you may be given mostly to another items also, customer directly deposited into the bank or some checks dishonored, like that. So if in case of customer directly deposited into the bank, you need not to consider there because already in the passbook it is there. But in your financial statement, when customer directly deposited into the bank, you have to reduce from your debtors because customer directly deposited, need not to adjust to passbook balance. Okay, because already recorded customer directly deposited means it is already in the passbook is there and you need to adjust in your cash book because passbook is given, you need not to adjust anything. Say checks dishonored. Already whenever checks dishonored already recorded in the passbook, that is what you are taking. You may adjust in your cash book, need not to adjust here, already recorded. But when checks dishonored, you need to make your debtor again as a debtor so that you can add to your debtor. Customer directly deposited minus from debtor, checks dishonor add to debtors. Okay, so in this way you may take always you can say that you need to take amended cash book balance, which is correct bank balance, into your balance sheet all the time. And this is the simple way to work out. At the end, what simply I can say regarding single entry system, in single entry system profit can be known by capital comparison method, statement of affairs method, net worth method. You can prepare a simply opening statement of affairs, asset minus liability, net worth or capital. You can prepare closing statement of affairs, asset minus liability, net worth, capital. Opening capital and closing capital when both are available, and you can have a statement of profit. So closing capital you can take, add drawings during this year, less opening capital, additional capital as well as opening capital to be reduced. The result is known as a trading profit. If any notional items are there, they should be adjusted. Say example, interest on capital, which will reduce your profit. Interest on drawings increases your capital. Any salary commission to be paid to partners, it will reduce your profit. These are called notional items. They should be adjusted. Okay, this is the simple way to find out the profit or loss in single entry pattern. Throughout the year, books maintained in single entry, and they want to know the result only by single entry. Okay, so the related problems in single entry pattern, and we can discuss in the next class. Okay, bye.